On behalf of the National Italian American Foundation, I thank all of you for joining us this afternoon. Our 6th Italian American Corporate Executive Washington briefing. We're especially honored that one of America's, and indeed the world's, most influential financial leaders has continued a tradition by taking time in his incredible schedule to be with us to address our group today. Thank you very much, Mr. Greenspan, for being with us today. I extend appreciation to those NEAF supporters who are always there when we need them and who have helped to co-sponsor this CEO briefing. Jonathan Kempner of the Mortgage Bankers Association, Joseph Del Raso of Pepper Hamilton, Mario Gabelli of Gabelli Asset Management, and Howard Levine of ARC's Commercial Mortgage Company and a friend of mine for the last 50 years. Thank you all. As most of you know, Italian Americans, like many Americans, have benefited from the American dream and now head some of the nation's largest corporations, many of them represented here today. They represent the best of our heritage and culture in an arena unfamiliar to them until recent decades. Those of us who have been successful have an opportunity and an obligation to help those in greatest need and to support organizations like NEAF that help the next generation. I know we can count on you for your continued support. All of us who serve on the NEAF Board of Directors are volunteers who share our love of our heritage and a desire to see the organization grow and continue to promote the best of our heritage. Our chairman, for the past 6 years, has dedicated his life to that goal and given countless hours of work to ensure that the mission of NEAF is upheld. Ladies and gentlemen, it is my pleasure to introduce NEAF Chairman Frank Guarini. Frank?
Thank you for that fine introduction, Angelo. I welcome all of you. It's a privilege to be here with Alan Greenspan and introduce a very famous personality who really needs no introduction. It's like a Monsignor trying to introduce His Holiness, or even a seminarian, if you will. But Alan Greenspan has been with us on 6 occasions in the last 10 years. We've been very grateful for his commitment to us. And although he needs no introduction, I want to really use this occasion to thank him for his public service, for what he's done for America, for what he's done for our economy, for his insights, for his talent. And he's, as you know, has served under 4 presidents, President Reagan, the first Bush, Clinton, and the present President George W. Bush. And he has made a tremendous impact in the economic world. He's probably the most important single voice here and abroad speaking on matters of the economy. I was very fortunate to have been on the Ways and Means Committee for 14 years when I served with some of you members here in Congress, John LaFalls and Ben Gilman and others here. And he appeared regularly before the Ways and Means Committee, and it was a true education. When he talked on matters of the budget, tax policy, Social Security, when you headed, Alan, the Social Security Committee, the Blue Ribbon Committee that we transformed and completely redrew the lines with Social Security here in a total revision. So your service has really set a very high bar that very few people have reached. And you know, on a personal note, I remember having talked with the chairman on a few occasions, and we just reviewed that we were in Villa d'Este together, Italy, and he has a warm spot in his heart for Italy. And as many of you may know, or may not know, he's an accomplished musician, that his career before he became the chairman of the Federal Reserve was that of a musician. He toured the country, throughout the whole country with a band, and he played the clarinet and sax, I understand, and he was quite talented and quite accomplished. And he said to me, you know, I would sit behind the back of the bus or train, wherever I was, and I found myself reading economic books all the time. And you know, there my colleagues we're touring the country, we're playing from city to city, going from hamlet to hamlet, and we're doing our thing, and yet I've been interested in economics. So I decided that perhaps I should really do something more serious with economics. He got his doctorate at NYU, did again still advanced studies at Columbia University, and then here he is today, the leading voice on the economy in the world. And we're very grateful for you, Alan, for everything that you've done, for your years of service, and for what you have meant to NIAF. So let me introduce to you the most outstanding American, Chairman Alan Greenspan. Thank you, Alan.
Thank you very much, Frank. That was very kind. I remember, I think it was the first time I appeared before this group, Al D'Amato anointed me an honorary Italian. And I didn't raise the issue at the time, but I guess I should have, because I don't know the answer to it, as to whether there was a sunset legislation involved in that or a statute of limitations of one form or another. So the fact that you're still inviting me suggests that it was an open-ended honorary degree. So I appreciate it, and I'm delighted to be here and find this an extraordinarily effective organization over the years. And needless to say, I've met a number of people and have a number of friends who are part of this organization, and have worked with them, argued with them, disagreed with them, fought with them, but it was real civility in the end. And generally, I've had nothing but favorable occasions when I've been here. Today, I'd like to discuss an issue which I suspect most all of you have been acutely concerned with over the last number of months. Indeed, if you haven't been, you've been somewhere under a rock somewhere. And that is not meant as a double entendre. I meant the first. Anyway, owing to the current turmoil in the oil markets, a number of analysts have raised the specter of the world soon running out of oil. This concern emerges periodically in large measure because of the inherent uncertainty of estimates of worldwide reserves. Such episodes of heightened anxiety about pending depletion date back a century and more. But unlike past concerns, the current situation reflects an increasing fear that existing reserves and productive crude oil capacity have become subject to potential geopolitical adversity. These anxieties patently are not frivolous, given the stark realities evident in many areas of the world. While there are concerns of seeming inadequate levels of investment to meet expected rising world demand for oil over coming decades, technology, given a more supportive environment, is likely to ensure the needed supplies, at least for a very long while. Notwithstanding the recent paucity of discoveries of new major oil fields, innovation has proved adequate to meet ever-rising demands for oil. Increasingly sophisticated techniques have facilitated far deeper drilling of promising fields, especially offshore, and have significantly increased the average proportion of oil reserves eventually brought to the surface. During the past decade, despite 250 billion barrels of oil extracted worldwide, net proved reserves rose in excess of 100 billion barrels. That is, gross additions to reserves have significantly exceeded the extraction of oil the reserves replaced. Indeed, in fields where 2 decades ago, roughly 1/3 of the oil in place ultimately could be extracted, almost half appears to be recoverable today. I exclude from these calculations, incidentally, the reported vast reserves of so-called unconventional oils such as Canadian tar sands and Venezuelan heavy oil. Gains in proved reserves have concentrated among OPEC members, although proved reserves in the United States, for the most part offshore, apparently have risen slightly during the past 5 years. The uptrend in world proved reserves is likely to continue at least for a while. Oil service firms still report significant involvement in reservoir extension and enhancement. Nonetheless, growing uncertainties about the long-term security of world oil production, especially in the Middle East, have been pressing oil prices sharply higher. These heightened worries about the reliability of supply have led to a pronounced increase in the demand to hold larger precautionary inventories of oil. In addition to the ongoing endeavors of the oil industry to build inventories, demand from investors who have accumulated large net long positions in distant oil futures and options is expanding once again. Such speculative positions are claims against future oil holdings of oil firms. Currently, strained capacity has limited the ability of oil producers to quickly satisfy this markedly increased demand for inventory. Adding to the difficulties is the rising consumption of oil, especially in China and India, both of which are expanding economically in ways that are relatively energy intensive. Even the most recent notable pickup in OPEC output, by exhausting most of its remaining excess capacity, has only modestly satisfied overall demand. Output from producers outside of OPEC has also increased materially, but investment in new producing wells has lagged, limiting growth of production in the near term. Crude oil prices are also being distorted by shortages of capacity to upgrade the higher sulfur content and heavier grades of crude oil. Over the years, increasing demand for environmentally desirable lighter grades of oil products has pressed refiners to upgrade the heavier crude oils, which compose more than 2/3 of total world output. But refiners have been only partly successful in that effort, judging from the recent extraordinarily large increases in price spreads between the lighter and heavier crudes. For example, the spread between the price of West Texas Intermediate, a light, low-sulfur crude, and Dubai, a benchmark heavier grade, has risen about $10 per barrel since late August to an exceptionally high $17 a barrel, at least as of earlier today. While spot prices for WTI, that is West Texas Intermediate, soared in recent weeks to meet the rising demand for light products, prices of heavier crudes lagged. This temporary partial fragmentation of the crude oil market has clearly pushed gasoline prices higher than would have been the case were all crudes available to supply the demand for lighter grades of oil products. Moreover, gasoline prices are no longer buffered against increasing crude oil costs as they were during the summer surge in crude oil prices. Earlier refinery capacity shortages had augmented gasoline refinery marketing margins by 20 to 30 cents per gallon. But those elevated margins were quickly eroded by competition, thus allowing gasoline prices to actually fall during the summer months, even as crude oil prices remained firm. That cushion no longer exists. Refinery marketing margins are back to normal, and hence future gasoline and home heating oil prices will likely mirror changes in costs of lighter crude oil. With increasing investment in upgrading capacity at refineries, the short-term refinery problem will be resolved. More worrisome are the longer-term uncertainties that in recent years have been boosting prices in distant futures markets for oil. Between 1990 and 2000, although spot crude oil prices ranged between $11 and $40 per barrel, for West Texas Intermediate crude, distant futures exhibited little variation around $20 per barrel. The presumption was that temporary increases in demand or shortfalls of supply would lead producers with sufficient time to seek, discover, drill, and lift oil, or expand reservoir recovery from existing fields to raise output by enough to eventually cause prices to fall back to the presumed long-term marginal cost of extracting oil. Even as increasingly inhospitable and costly exploratory environment, an environment that reflects more than a century of draining the more immediately accessible sources of crude oil, did not seem to weigh significantly on distant price prospects. Such long-term price tranquility has faded dramatically over the past 4 years. Prices for delivery in 2010 of light, low-sulfur crude rose to more than $35 a barrel when spot prices touched near $49 a barrel in late August. Rising geopolitical concerns about insecure reserves and the lack of investment to exploit them appear to be the key sources of upward pressure on distant future prices. However, the most recent run-up in spot prices to nearly $55 a barrel, attributed largely to the destructive effects of Hurricane Ivan, left the price for delivery in 2010 barely above its August high. This suggests that part of the recent rise in spot prices is expected to wash out over the longer run. Should future balances between supply and demand remain precarious, incentives for oil consumers in developed countries to decrease the oil intensity of their economies will doubtless continue. Presumably, similar developments will emerge in the large oil-consuming developing economies. Elevated long-term futures prices, if sustained at current levels or higher, would no doubt alter the extent of and the manner in which the world consumes oil. Much of the capital infrastructure of the United States and elsewhere was built in anticipation of lower real oil prices than currently prevail or are anticipated for the future. Unless oil prices fall back, some of the more oil-intensive parts of our capital stock would lose part of their competitive edge and presumably be displaced, as was the case following the price increases of the late 1970s. Those prices reduced the subsequent oil intensity of the United States economy by almost half. Much of the oil displacement occurred by 1985, within a few years of the peak in the real price of oil. Progress in reducing oil intensity has continued since then, but at a lessened pace. The extraordinary uncertainties about oil prices of late are reminiscent of the earlier years of oil development. Over the past few decades, crude oil prices have been determined largely by international market participants, especially OPEC. But that was not always the case. In the early 20th century, pricing power was firmly in the hands of Americans, predominantly John D. Rockefeller and Standard Oil. Reportedly appalled by the volatility of crude oil prices in the early years of the petroleum industry, Rockefeller endeavored with some success to control those prices. After the breakup of Standard Oil in 1911, pricing power remained with the United States, first with U.S. oil companies and later with the Texas Railroad Commission, which raised allowable output to suppress price spikes and cut output to prevent sharp price declines. Indeed, as late as 1952, U.S. crude oil production, 44% of which was in Texas, still accounted for more than half of the world total. However, that historical role came to an end in 1971 when excess crude oil capacity in the United States was finally absorbed by rising demand. At that point, the marginal pricing of oil, which for so long had been resident on the Gulf Coast of Texas, moved to the Persian Gulf. To capitalize on their newly acquired pricing power, many producing nations in the Middle East nationalized their oil companies. But the full magnitude of their pricing power became evident only in the aftermath of the oil embargo of 1973. During that period, posted crude oil prices at Ras Tanura, Saudi Arabia, rose to more than $11 a barrel, significantly above the $1.80 per barrel that had been unchanged from 1961 to 1970. A further surge in oil prices accompanied the Iranian Revolution in 1979. The higher prices of the 1970s brought to an abrupt end the extraordinary period of growth in U.S. oil consumption and the increased intensity of its use that was evident in the decades immediately following World War II. Between 1945 and 1973, consumption of petroleum products rose at a startling 4.5% average annual rate, well in excess of the growth of real gross domestic product. However, between 1973 and 2003, oil consumption grew on average only 0.5% per year, far short of the rise in real GDP. Although OPEC production quotas have been a significant factor in price determination for a third of a century, the story since 1973 has been as much about the power of markets as it has been about power over markets. The signals provided by market prices have eventually resolved even the most seemingly insurmountable difficulties of inadequate domestic supply in the United States. The gap projected between supply and demand in the immediate post-1973 period was feared by many to be so large that rationing would be the only practical solution. But the resolution did not occur quite that way. To be sure, mandated fuel efficiency standards for cars and light trucks induced slower growth of gasoline demand. Some observers argue, however, that even without government-enforced standards, market forces would have produced increased fuel efficiency. Indeed, the number of small, fuel-efficient Japanese cars that were imported into the United States markets rose throughout the 1970s as the price of oil moved higher. Moreover, at that time, prices were expected to go still higher. Our Department of Energy, for example, had baseline projections showing prices reaching $60 per barrel, the equivalent of about twice that in today's prices. The failure of oil prices to rise as projected in the late 1970s is a testament to the power of markets and the technologies they foster. Today, despite its recent surge, the average price of crude oil in real terms is still only 3/5 of the price peak of February 1981. Moreover, the impact of the current surge in oil prices, though noticeable, is likely to prove less consequential to economic growth and inflation than in the 1970s. So far this year, the rise in the value of imported oil, essentially a tax on U.S. residents, has amounted to about 0.75% of GDP. The effects were far larger in the crises of the 1970s. But obviously, the risk of more serious negative consequences would intensify if oil prices were to move materially higher. In summary, much of world oil supplies reside in potentially volatile areas of the world. Improving technology is reducing the energy intensity of industrial countries, and presumably recent oil price increases will accelerate the pace of displacement of energy-intensive production facilities. If history is any guide, oil will eventually be overtaken by less costly alternatives well before conventional oil reserves run out. Indeed, oil displaced coal despite still vast untapped reserves of coal, and coal displaced wood without denuding our forest lands. Innovation is already altering the power source of motor vehicles, and much research is directed at reducing gasoline requirements. At present, gasoline consumption in the United States alone accounts for 11% of world oil production. Moreover, new technologies to preserve existing conventional oil reserves and to stabilize oil prices will emerge in the years ahead. We will begin the transition to the next major sources of energy, perhaps before mid-century, as production from conventional reservoirs, according to central tendency scenarios of the Energy Information Administration, is projected to peak. In fact, the development and application of new sources of energy, especially non-conventional oil, is already in train. Nonetheless, it will take time. We and the rest of the world doubtless will have to live with the uncertainties of the oil markets for some time to come. Thank you very much. It's certainly been a pleasure, as always, to be with you. Thank you very much.
Mr. Chairman, on behalf of everyone here, we're deeply in your debt for that very fine, outstanding presentation and that thorough understanding of our oil crisis, which certainly affects our marketplace greatly today. I want to really, truly thank you for joining with us once again. On behalf of everybody here, I can say that thank you, and thank you again. We will have a 5-minute break, and then we will go into we'll have some very fine speakers that will be talking about the economy, and we'll break now, and then we'll resume presently when I'll introduce Tina Johnson, who will conduct the rest of the program. So thank you again, Mr. Chairman.